things are looking pretty good in the cattle industry right now for the most part. And we'll just look at some of those things that are really going and blowing and see if we can't talk this out. Cattle prices have really started to strengthen. The futures market has had it figured out for a long time. Now we haven't quite reached their lofty expectations for the summer and fall, but um, we definitely did see cash prices start to run up on calf and feeder cattle prices. We These are just some major things hitting the market right now. The drought is definitely influencing heifer retention. Aaron's already showed uh, the drought monitor, and I'll show it again, but very briefly. But those areas are definitely being impacted on heifer retention and slaughter rates. Uh, Folks have had opportunities to hedge in 2021, and there's still a lot of opportunities there. And hopefully, the last slide in this whole set will show some things that to be looked at. And the international market has been really strong. So demand has been strong both domestically and internationally for beef, which has really supported cattle prices. But just very briefly, we want to see uh, what fed cattle have been doing. Fed cattle prices typically start to decline this time of year, but they have not shown any signs of declining. Cattle feeders probably should still be making a little more than what they're making off these cattle, given where beef prices are. But the packers are taking advantage of everything they can take advantage of. And this has been the steadiest price that I know of in my 9.5 years here. If we go all the way back to from April through here in the middle of August, this is the steadiest price I have ever known fat cattle to be at. Essentially, we're looking at a $5 or $6 range over that entire 5 month period or so. And when you think about that, and the fact that we haven't started to see these prices decline uh, for I mean, typically late summer, these prices decline. They haven't done that, and I don't really expect them to take a big dip because we packers are managing slaughter levels very well right now to their own benefit. But at the same time, we know there's not as many cattle going on feed, and cattle on feed numbers when we get those this week are probably going to show that we don't have as many cattle on feed. Um, Here's what 5 and 6 weight steer prices are doing. So for cow calf producers, things are looking pretty fair. $800 a head is not a bad value for a 550-pound steer. On the flip side, people that are buying those cattle seems kind of steep. We're here. We are in late summer, fixing to head into the fall marketing time frame, and will prices soften in the fall for these cattle? Probably a little bit, but not nearly like they have been. They will not soften like they've been doing. So we might be looking at these prices getting down to maybe 145 at their lowest this fall. But very, very strong, and may stay higher than 145. But it's impossible to predict them exactly. But I think a lot of our producers will be satisfied relative to previous years in what they're going to receive for their calves this year. Then here's just weekly run auction 7 to 8 weight steer prices. So this kind of gives us an idea of yearling cattle prices. And a lot of our yearlings are sold in load lots, but this still gives us a good upward trajectory on where these prices have gone since earlier in the year. So if we look at, you go all the way back to January, and it's essentially just a straight, we have a really nice trend line that can be drawn from January through August, and prices just strengthen and strengthen and strengthen. Now there was some dips there at times, but this market, based off the futures market, is going to continue to increase. I don't know if I'm that optimistic, but where we're sitting right now is not a bad place to be marketing an 850 pounder for a little over $1,200 or so. Not a bad thing. People are probably making money at those prices based off what they paid for those cattle. Now the flip of that is what they had to pay for cattle. If there's people buying those 5 to 6 weights that are then turning them into 7 to 8 weights or 9 weights, the cattle are going to be a little more expensive. But then again, if we got people that are backgrounding their own cattle, home raised cattle, there's a lot of value in carrying them to 700 to 800 pounds. And as can be seen here, that they're pretty strong value. the market that cow-calf producers should really be focused on right now is getting rid of their slaughter cows. These slaughter cow prices hitting 70 cents again this week. I guess I looked at some of the probably Dixon, Unionville, and Knoxville. That covers a lot of the state. Really, really strong price on slaughter cows. If you've got producers, or if you are a producer that needs to get rid of some slaughter cows, now is the time to do it. I wouldn't want to take a chance on letting these prices decline on me, because 70 cents on a 1,200 pound animal is $840, and that's a really, really good salvage value on a cow that needs to be moved out of the herd. Slaughter so far, heifer slaughter is up a little over 8%, steer slaughter up 6%, and beef cow slaughter up nearly 10% so far this year. And so what that's pointing us towards, and I think I've written an article in the TCA magazine. If you get that, it'll probably be this next month or whatever it is, but it has to do, I think it's TCA, it might be Farm Bureau, I don't remember. But anyway, it doesn't matter. Talking about looking at how the herd is going to either grow or decline in numbers come January 1. And I fully expect us to have lower beef cow numbers come January 1, 2022 than what we had as of the beginning of this year. And so with that in mind, one can pretty much think that we should continue to see stronger feeder cattle prices and calf prices. We have increased heifer slaughter, increased beef cow slaughter, and a lot of that is due to, when you compare that to April, May, and June of last year, we had reduced slaughter levels. And so part of those numbers are inflated because of that during coronavirus. But at the same time, we're going to have a smaller cow herd, which means a smaller calf crop, which means stronger prices. And I'm looking for a bull market to go probably at least 2 or 3 years. So higher prices the next 2 or 3 years. And that's good for cow-calf producers, and then margin operators just have to continue to consider the margin that they're working on. Meat production, man, we've got a lot of meat. Beef production up 6%, pork production up 0.4%, and broiler production up 0.4%. We've had really, really strong demand for beef. Pork demand is not too bad either. Poultry, chicken products is so. But we've got a lot of meat on the market, no shortage of it. Something that's been interesting, I'm sure some of y'all have read, where they're going to increase payments for supplemental nutrition assistance programs. So SNAP, food stamps, those types of things. They're going to increase, USDA is going to increase payments to those in those programs to families. It depends on how you look at it. From I guess a political standpoint, if you're a conservative person, you say, well, why are we increasing these payments? But then from a farming standpoint, you say, well, that's more dollars that are going into food consumption. So in reality, that should help the product that you're producing, because that's food consumption. So there's multiple ways of looking at it, but that will influence commodity prices to some extent as consumers have more dollars to spend, even though it's taxpayers putting the dollars in to do that. So some key implications to all this meat is we do have to export some beef and pork products, and knowing that domestic beef demand is it's not just still pretty good, it's really good. Going back several years, it's the strongest we've seen, but we have to export beef and pork products. So the whole thing is Japan and South Korea are still really, really strong markets, but China is becoming a bigger and bigger player in the beef export world. They've always been a pork destination and a soybean destination, but beef and corn exports have really picked up to that region. And the corn is going to feed hogs in China. Beef is going to feed people that have found out they really like beef. So things to be thinking about, here's our imports. We've had very moderate imports up to this point in the year. A lot of that's due to reductions from New Zealand and Australia. We'll continue to pick those up slightly, but they'll again decline as a lot of those cows, those cows that calved back in the spring are marketed in October, November, we'll see those imports again start to decline. But they've been very moderate relative to the previous years. And that's because of the drought situation in Australia and New Zealand, and them not being able to export as many animals. That's also what has helped support those slaughter cow prices, is the demand for that lean beef that we would typically import. Exports have been really, really strong. Some of the best export months we've had. A lot of that is due to China, as I'm fixing to show. But before we get to that, let's just look at how this graph looks. If you can see this solid blue line, you can see where Australia was up here around 60 million pounds, and then here since the beginning of the year, they've been essentially below 40 million pounds every month. So you take a third of the imports from Australia away, and you start to understand why we've really reduced imports. Some of those imports have been made up by Mexico and Canada, which is, I mean, that's pretty typical. I mean, they're two of our major trading partners, but we just can't always get enough lean beef out of those areas to satisfy what we need. So that's continuing to support that slaughter cow market. But on the export side, the really key thing here is to note as you look at this red line for China, and going back to 2018, nothing, and then we get to the middle of last year and they start to pick up, and now they're the number 3 export destination for beef. You still have South Korea and Japan leading the way, but I mean, there's the possibility that China could overtake them if they so desired. Of course, Canada and Mexico are still major trading partners just because of their close proximity, but things are pretty much status quo there. Canada never really changed much at all. You can see where Mexico was in dire straits during the midst of that pandemic, and then really increased their imports of U.S. beef, and then they pretty much fell back into a kind of a typical range. Now, this graph if we didn't have the dotted line in there for 2020, this run up in box beef prices or wholesale beef prices would really be amazing to look at, because going from this 200 to 250 level up nearly to 350, and now we're turning back around. I wouldn't have expected here where we are today being trading over $300. At first I wanted to chalk this up as Labor Day demand for a couple of weeks, and it may still be, but I don't know if that's going to be the case, because we typically don't see Labor Day demand this late. I realize Labor Day is still a couple of weeks away, but most of that purchasing is done in early August for those purposes. And we've had 3 or 4 straight weeks now where box beef prices have continued to increase. And most every week we see a $10 to $15 price change. And that goes all the way back here into March, where we made this really good run for 11 or so weeks and gained over $100 or $1 a pound on box beef prices. So just really, really strong prices. And we kind of expected this decline as it happened in late summer, but this complete turnaround, as big a jump as it's made here the past 3 or 4 weeks, was unexpected. For it to turn around marginally, okay, but it's been a really, really large jump, and I don't know what I ought to say about that right now, other than at the end of the day, the rib and the brisket is what has been leading the way here. And I guess rib and brisket are common things to eat on Labor Day. People really like to throw things in the smoker. That'd be your brisket. People like steaks. They throw those on the grill. That's a great thing for Labor Day. And so that's what's been driving that market as of late. So we'll see if it continues to drive it or not. From a feed standpoint, Aaron's already talked about corn, soybean prices. But yeah, that drought monitor takes over a large portion of cattle country, as well as some states that are major corn and soybean producers in the Dakotas and Minnesota and even northern Iowa. I mean, we don't always realize how much crop is produced in those northern states, primarily because they used to be small grain producers and small oilseed producers, and then they decided to get in this whole game of corn and soybeans. And I you know, a year ago, two ago, those folks up north got hung out to dry on some of their beans because they didn't have anywhere to go with them. And you know, so that there are still some logistical problems up there as well. But this year, it doesn't matter what the logistics are, because they've had such severe drought, it's going to really not put a knock in their crops. And I think what Aaron showed, maybe 24 bushel was the USDA projection for bean production in North Dakota. I don't remember what it was. If he had the corn projection, I might have missed that. But you know, we're talking about really low production, probably cut in half essentially. And those are things to think about. But it's really influencing the cattle herds. They've had to, you know, liquidate some of these animals, and so overall national herd inventory, that's why I'm saying it's probably going to decline to some degree moving into 2022. You know, you look at how, you know, with the fact that 40 to 45% of range and pasture grounds in poor or very poor condition, we wouldn't really know that in our part of the country. But you know, the Northeast Tennessee was getting a little dry. I was up there a couple of weeks ago. It was getting a little dry up into Southwest Virginia. But I think they've since had some rains, which should really spur some late summer and fall growth in pastures. So we don't really realize this very poor condition of 40 to 45%, but a lot of that's made up of those out west and the northern plains. Corn prices in Omaha around 630 this week. That is, it's still expensive. That's going to put your cost of gain over $1 probably in the feedlot. So it's not cheap to feed cattle right now. And sometimes that makes me start to think about how much they are actually paying for feeder cattle relative to what live cattle are, because it doesn't necessarily pencil very well. But feedlots have to feed cattle, so they buy them. Here's what I mean, cost of gain for cattle that came off of feed in June in Kansas was about $1.01, $1.02. Not going to say those cattle made or lost money. They probably still made money just because a lot of those cattle were bought fairly cheap 6 months earlier. But paying what they're paying for them now, and expectations of cost being $1 plus, really leaves thin margins on those cattle. So there's reasons to be thinking about hedging those cattle. The November board, well, this is probably, I think this is probably Monday's close at 166.60 on the November. You know, we've had a really strong run since May. I think actually the first week of May was probably some of the lowest prices we saw, really declined. But since then, prices have just gone up. And there are some really nice hedging opportunities. There's been really strong resistance at that 167.5 area to 168. So, you know, if you have to just work off the cash market all the time, well, it looks promising going into November. But I'm not sure that our CME feeder cattle index price, which is trading around 156, has $10 more a gain in it between now and November. So there may be may need to be some thinking about on what you need to do for these cattle that are going to be sold October and November. We've already started to see the September futures contract lose a few dollars this week, because the August contract's fixing to go off the board, and so September would be the nearby, and it was trading at 162, 163. And you say, well, 163 and 156, well, there's still $7 difference in the feeder cattle index and the September board. So the board has come back to the index, and you know, I mean, 156 is not a bad place to be in a cash price. But I don't know that we're going to have $10 more a gain between now and November on those cattle. That doesn't mean that we won't, but I think it's going to be a tough hill to climb. Then looking in January, still 166. I mean, for folks that know they're going to be selling cattle that time of year, looking at insurance products, looking at the futures and options are things that really need to be considered. We have a lot of producers that do a great job of managing cattle, growing cattle, breeding cattle, but we don't want to be left to the market's whim of, well, today this happened, so market collapses and we're just going to be out a bunch of money. Do some back of the feed sack math, kind of have an idea of what you're going to have in those animals, and see if locking in a price minus whatever our basis is that time of year will give you a profit. And if it does, it might not be a bad decision. So with that, my fed cattle price forecast is fairly strong. We got some fairly strong expected prices here. Looking into the fourth quarter, things are going to improve as we head into the holiday season. January through March of next year, probably we'll hit that 130 mark at some point. Now I'm giving you an average over that quarter, but probably we'll see $1.30 at some point. We could even see $1.30 in the fourth quarter of this year, but I don't think the average over the fourth quarter of this year is going to get that high. But we definitely could see a week of 130 or so in those fat cattle. And then here's 5 to 6 weight steers run through the weekly auction, and then of course 7 to 8 weight steers and heifers sold as load lots for my expectations from August through the end of the year. August is where we are right now, so that tells you what I think they're probably valued near. For people that are buying cattle, like I say, these prices, I told you we might get a week or so where October, November time period prices on these 550s go down to 145. But as you can see, based on my projections, I don't expect those prices to last very long. I'm expecting still an average of a $1.50 for October and November time period. And so when you're working off of that as a margin operator, you have to think about what are you going to have out of selling those cattle going into later months. But for the cow-calf producer, this looks really, really nice. $1.50 for a 550 is not a terrible price, and if you're not making a little money on that, we need to consider some other things and look at where our costs are and what we need to do, because those are fair prices. And on top of that, I do think prices will be a little higher in 2022 than 2021. So there is some optimism going into that time period, but not for forever. So just want to look at some ways to protect the price very briefly. Don't worry about how these things work, but looking for expected price of an 800-pound steer in January, because that still gives us some horizon from today to January. You can sell that January futures at 166 with a expected $7 basis, which gives us a price of 159 here at home. If 159 is profitable, well then that might be a good option. Aaron talked about the futures having those margin requirements. That means making sure you have enough money in the account to hold the position. That's what that means. And sometimes that means working with a lender, and sometimes that means just that's where you have your cash hold up instead of invested in other things. If you don't like the idea of locking in a price and being subject to those margin calls, you could purchase a 162 put for $6. It's actually $5.50 yesterday, but $6 is a nice round number that it's easier to do math with. And so it was, like I say, it's a little cheaper than $6, but then your $7 basis means that your lowest price is going to be 149 at home. So you can have anything at 149 plus. If prices keep going up, maybe you don't even need your put option, and so the lowest price you're going to get is 149. A way to offset some of that $6 cost would be this a $3 selling a 174 call for $3. Actually, that was 350 yesterday. So if we made this 550, the cost of your put and the sale of your call, you would only have $2 in that. So you could bump this floor up to 153, and bump all this up to 153 and that to 165. It's pretty nice. You know, cheap way of locking in some cattle to give a floor price, but it also limits your upside to this 164 area. The same time, if you know, maybe you don't have 50,000 pounds to put in the futures market, maybe you've got 15 head at the house that you need to sell in January. Well, you can purchase a LRP at 162 for $4. LRP is a little less expensive for the same floor price. That's because of the government subsidy, but it's also not as fluid of a product. It's a little more rigid. But I mean, it gives you a floor of 151, and your price range is going to be 151 plus. And then you could do the same thing with the LRP and the selling of a call. But my point is not to teach you exactly what all these things do. The point of this is to show people that are watching this morning or watching this later that there are some basic things we can do at a fairly inexpensive cost. And lock in some prices that will probably result in profits for many of our producers. So with that, I think we're going to have a potential bull market for the next 2 to 3 years, and cow-calf profitability has improved. And so we need to look at some opportunities here. So with that, I'll open it up for questions.